We went in November, December, if you recall, we had peak optimism on Trump. He couldn't do anything wrong. He was almost Superman to March, April, where we went to a peak pessimism phase where we thought everything that this administration was doing wrong. We were dumping American assets, whether it's the dollar, whether it's bonds and equities. As they say, the reality is always somewhere in between. We think that, especially on the US dollar, I think the crisis of confidence that the administration may have caused along the line, in parallel to trying to address the structural problems that the US economy has, were maybe a little bit too much in one go. The dollar obviously reacted the hardest, and we can see the decoupling that the US dollar did with the 2-year spreads, which is quite an interesting chart to look at. The reality is, we think we've got a lot of positives to come. We've got tax cuts coming through. We've got deregulation also coming through. And we've also got the de-escalation in the tariff tantrum, if you want to call it, also coming through. I think the market went a bit too far with how, with wanting to bury the dollar as a reserve currency. And the last 3-day price action shows that snapback and how violent it can be.
Omar, so interesting that you mentioned this 10-year yield correlation with the dollar. It is seen as a key indicator, and of course, it's something that we've also been tracking over the last couple of weeks. Just walk me through what you think happens next here. Does the divergence continue? And if so, what does it reflect?
That's a great question. We actually think the divergence doesn't continue. We actually think the quote-unquote crisis of confidence, when we heard about Trump wanting to fire the Fed, and wanting to, go overboard with tariffs on the rest of the world, that seems to be calming down. I think the calmer heads are prevailing, especially with Scott Bessent's voice being more and more dominant in the administration. With that in mind, we do think that the gap between the dollar and the 10-year Treasury is likely to close. Interestingly, I would say that the absolute yields, if you look at 10-year Treasury yields in the last 3-4 months, if you forget the price action in the middle, hasn't really changed, which tells you that the bond market is not really expecting something major to come from, whether it's an inflationary shock or a growth shock on the back end, right? Tariffs are ultimately transitory. They're a one-time step up in prices, even if they do occur. And the private sector is very, very savvy and smart at navigating those challenges. We really underestimate how good the private sector, especially in America, can be, which is why in our mind, we think the dollar rallies back to the middle of the range. We also think equities come back. I mean, the last 2 days has been a bit of proof to that. I don't think we make new highs. That's not really where we're at. But we use those panic moments in the market where the market seems to think we're in 2008 or in 2020 to come back and say, hey, don't go to the extremes, fade the extremes, and live in the middle. That's almost how we're positioning ourselves, Ben.
Okay, Omar, so walk me through what you're telling high net worth clients in the region right now as well. If we do see this dollar return to favor and we see equities coming back, what does that mean for regional positioning?
I think regional investors have typically been underweight U.S. equities. There's almost a perpetual fear of overvaluation, which we've been hearing about for several years. So in that sense, I think investors are likely to leg in, but they'll leg in a very conservative way via structured products or via Max 7, but very, very cautious positions. I think the dollar rallying is generally helpful because most of the investors in the region are dollar-centric, which is a positive. But ultimately, we do see a need for client portfolios here to be a bit more diversified away from domestic sectors and the domestic economy into global assets. And this is what we're trying to convince them to do.
So, Omar, what about what happens in the region more broadly? This week we've seen twin downgrades from the IMF and the World Bank. Of course, the oil price outlook has been decidedly bearish as well, with crude tracking at around $60 US. Doesn't that macro backdrop spook high net worth investors?
It doesn't. It doesn't. I think it does in a way that you see your kind of total wealth take a hit, or your local business or local investment take a hit. The reality is, times like these remind you of the need to have a diversified portfolio. They remind you of how important it is to have not only across regions, but across asset classes, right? We're talking about fixed income, equities, and alternatives as well, right? So alternative asset class, albeit hedge funds, and private equity have actually been solid performers. They've been solid diversifiers to your local business, right? So we use those moments to remind clients that, hey, you cannot be, even if you're compounding 10, 15, 20% on your local business, it is super important to have a steady, diversified portfolio that protects you in times of stress, like the ones we're going through now.
Indeed. One of the other things you mentioned, and I wanted to pick up on this because it's the bull signal here. You were talking about how we're going to see potentially these pro-growth policies coming out of the United States, deregulation on the agenda, and of course the big one that investors are watching right now, I would contend, is what Trump is going to do with tax cuts, because that could ultimately perhaps reverse the market sentiment we've been seeing. It could be a catalyst for equities moving forward. What does that mean for regional investors in particular, and what is the timeline on that? Because this is an administration where you have to focus on what Trump does, not necessarily what Trump says. And I think investors are still trying to find the middle ground there.
I think you hit the nail on the head. If you remember Trump 1.0, 2017 to 2021, it was almost the same. It took the market a year to get used to the tweeting, the sort of, not, I don't want to say erratic, I want to say the untimely or the random kind of messages that the administration sends across. Eventually, you get used to it. Vol tends to come down, and the market just looks at what he does. We expect it to come in the coming 2 months. We don't have a clear yet timeline, but from the kind of informed people we speak to, we do expect it to come in the next couple of months, as I said. For regional investors, typically, when you get a U.S. tax cut, ultimately benefits U.S. investors in direct. Indirectly, of course, we do get the benefits in the region, naturally, because asset prices tend to come back. A lot of our investors here do have U.S. exposure when it comes to their public portfolios, especially in stocks. So this is where the kicker comes through. The reality is not only the pro-growth policies that are come with tax regulation, with tax and deregulation. The other side of that coin is once we get a final cut on the tariff program. So once that's final, once we have a final version, I think the market can breathe a sigh of relief, because now we're still in this how bad can it get setup. So once you get a final cut on this, and even if it's high, the market can adjust, and I think the market can move on. That's how we're looking at it.
Fair point. Right. Omar, before I let you go, of course, we like to focus on the positive, but I have to ask you about the negatives as well. What would you say is the biggest risk right now out there in terms of global and regional positioning? What are you telling clients about what to avoid and what to watch out for over the next 3 to 6 months?
Well, then definitely the risk is a growth shock. And we've been scavenging the soft data, whether it's PMIs yesterday or surveys across the board, to try and see whether the uncertainty of April has really caused companies and purchasing managers and investors alike to completely go freeze. I mean, put yourself in the shoes of a CEO in the US right now. What do? Do you buy the goods? Do you raise your prices? Do you cut your prices? Do you anticipate? Do you wait? So this uncertainty is really what can cause the slowdown. And so we are watching and waiting and worrying about an economic slowdown to come in the next 2 to 3 months. That being said, the Fed has tools in the toolbox. The biggest risk is, of course, a stagflationary cocktail where you get a giant leap in prices with a collapse in demand. Historically, that's quite unlikely then, because these tend to be supply shocks that are super intense on the economy, with oil in the 70s, etc. We don't have that right now. And so we are mainly worried about a growth shock, not an inflationary shock. But for that, the data still hasn't confirmed that, which is very interesting. Even PMIs yesterday were resilient enough to show that the economy is still on track. So this is the risk. We're worried about it. We're watching for it, but we haven't seen it yet.